Everyone, it's Erich Reimer. I'm here today to talk about when bonds are not a safe haven. On Black Thursday this week, we saw the Dow post its biggest point decline in history, beating out its prior record of just 3 days ago on Black Monday when it posted its then biggest point decline in history amid this week's coronavirus concerns in the United States and an oil price shock. On Thursday, however, in contrast to the rest of the week and before, we saw that bonds, which normally in all their forms will increase in price as equities go down because people want to find a asset that is safer, and so therefore bond demand goes up, which causes the interest rates on them to net go down, and therefore the prices of the bonds increase. However, we saw on Black Thursday that no asset class was spared. We saw stocks begin to decline rapidly throughout the day, and while bonds initially were doing as they do, at least some bonds, and going up in price as equities went down, we saw as the day went on that bonds began rapidly declining, and some of them even declining more than equities. And so many people were wondering, why is that? Why was everything from short term government treasuries to long term corporate debt to every kind of other debt instrument out there pretty much suddenly just bleeding red? And the reason for that is sometimes when economic conditions, when the market as a whole is just going south too much, that causes a lot of asset classes to quote unquote converge because they believe that essentially a recession, a depression, a economic explosion, implosion, collapse, etc., is happening, which is essentially wreaking havoc across all asset classes. And so for bonds in particular, this reversal of behavior is because when a company is experiencing such turmoil in its financial situation, and so not just a small decline, a moderate decline, but a true sharp decline, then actually the interest rate on its bonds, the market interest rate or the price demanded essentially, will be higher for the interest rate, and therefore the price of the bonds will be lower because there are worries if the company can have the liquidity, equity, etc., to actually pay back those bonds. And so default risk increases. The worry about debt renegotiation, about the debt not being paid back at all, about other shaky things that affect what otherwise might have been seen as a um, investment grade bond, which means also that sometimes bonds are getting so bad fundamentally that they might even be downgraded because of such steep declines, whether within the company in particular or within the broader market. And therefore, that causes the actual bond price to decline instead of go up because people are worried that everything is collapsing and therefore, including the company's ability to pay back their liabilities. And with government bonds, that was more interesting as well. We saw government bonds, many of them post initial rallies throughout the day, but then many of them began going red as well, or at least holding steady and not going up or down. And that was worrying because that means that there might be worries over the credit worthiness of sovereign debt. And to clarify, I'm talking here about sovereign debt, and so not municipal debt, where municipalities are municipal corporations that are separate legally from the actual sovereign that they are created from. And so a city's debt, for example, versus the debt of France itself, for example. And so we saw a lot of those not do too well either. We saw the interest rates on some of those government debts actually increase over perhaps worries about the government's long term uh, financial well being. Of course, that's all erased on Friday, but nonetheless, it was a really interesting example of how when extreme situations happen, common market assumptions can be shaken up when you put things into these really stressed and overstretched situations. And certainly for a lot of investors, it was very interesting to live through firsthand. And so, happy investing out there, and let's see if we see any more interesting events and phenomenon happen in the financial markets over the near future.